My name's Liam, and you're joining me for the market roundup on the 1st of March. And in case you're wondering why I plastered my hands with cream, it's because I chuck soup all over them and it burns like hell. But even that wasn't enough to wipe the smile off my face today because it was a great day to be an investor. Today was one of those days where making money from stocks feels like the easiest thing in the world. Despite inflation fears and bond yields in multi-year highs, it felt like after a weekend and with the start of a new month, that investors had rediscovered their love for stocks. Asian markets led the way, China up 1%, Japan up 2.5%, and the Hang Seng up 1.5%. Australia was up, though nothing exciting down under. NIO was pretty notable, up almost 9% in China. Sony was among the leaders in Japan, up over 2%, whilst almost predictably, Taiwan Semiconductor Company, or TSM, was up 2.5% on the Hang Seng. The FTSE 100 was also up 1.6%, with 92 of its constituents recording a positive session on the day. It was almost predictably led by IAG, in the hopes that holidaying might happen over the key summer period after all. They rose 7%. Behind them were the house builders, as the UK's attention moved to Wednesday's budget update, where the suspicion is that a stamp duty holiday would be extended. Best performing was Taylor Wimpey, up 6%. Persimmon up 5%, and Barratt Development also up 5%. Also up was one of the UK's few notable tech stocks in Rightmove, a property website, up 4%. That's a company I've got on my watch list, but not yet pulled the trigger on. But it's been on a slide recently and may look tempting. The market was also very excited that Trustpilot has announced its intention to list in the UK, and it's hoped that the UK may attempt to create a more favourable environment for tech stocks moving forward. It's not big enough for the FTSE 100 yet, but should be right at home in the FTSE 250, and is a stock I will be looking at closely when available. Good news, I think. In terms of fallers, supermarkets made up 4 of the 8 losers on the day, as investors worried a windfall tax might land from the same budget update. Supermarkets have had a good year, but have undoubtedly been winners. COVID has also slowed the march of discounters who have been nibbling away at market share historically. They have significantly smaller delivery networks and very few convenience stores, so they haven't seen their numbers go up in the same way. Meanwhile, the FTSE 250 was keeping up, also up a good 1.5%. A bit more nuanced over here, though, and notable to me was that Jupiter Asset Management, Plus 500, and CMC Markets were some of the biggest fallers, down 4%, 3%, and 2% respectively. Digging into this, it appears that some were worried that with the lockdown due to come to an end, people might start spending rather than investing their money. Over in America, the market was even more dreamy as investors rediscovered their love of American shares, or at least their conditional love based on money printing, inflation hedging, and nowhere better to put their money. The NASDAQ rose 3%, whilst the S&P and Dow also rose 2% each. Apple was rediscovering its sex appeal, attracting a rise of over 5%, whilst Broadcom and Microsoft, shares I bought last week on the wobble, were up 4% and 2% respectively. Whilst Tesla also managed to charge above $700 once more, rising 6%. Perhaps the most eyebrow-raising rise was Etsy, though, up 11%. This was off the back of what one analyst described as going from niche to mass market during 2020, as its sales grew an incredible 127% in Q4. Impressive stuff, and congrats to any owners of that one. In terms of news this week, the UK manufacturing numbers were better than expected at 56, where anything over 50 represents growth, and where consensus had been 55. The only grey linings to that silver cloud is that the same survey showed clear pricing pressures, inflation, and a backlog of orders that were suggested could be linked to Brexit. Most investors took this in their stride, though, and chose to focus on rumours of what the Chancellor may be doing on Wednesday. Right now, consensus says he's still feeling generous, but with the UK debt now reaching £2 trillion, everybody suspects he's going to have to at least give some warnings as to where he's going to be targeting in the near future. That debt to GDP level currently stands at 85%. It's starting to look uncomfortable. But like any good politician, let's save worries for another day and take the bull by the horns of this very friendly start to the month. I've been Liam. Thank you for joining me, and good luck with your investing.